The leasing market was facing challenges in Q4 2024, a double whammy in fact. Supply of property was increasing for lease and softening demand as a result of a reduction in business confidence. This year has increasingly become more difficult as well. A couple of factors at play. Federal elections typically slow activity and disrupt the business community as people await policy direction and who is going to govern. American politics were also at play, and Trump's introduction of substantial tariffs has had an impact in demand with the leasing market. Incentives in most markets, in most size ranges in Sydney, have increased since Q4 last year and well into this calendar year. Whilst landlords have tried to hold face rentals to keep valuations firm, tenants have had expectations for increasing incentives as the supply of property has continued to increase. In the 10,000 square metre plus size range, it's not unusual for incentives to be as high as 20 to 25%, and the average transaction in the market is probably around 10 to 15% incentive level. Rentals in institutionally owned properties are remaining firm. However, in the private market, a lot of landlords have reduced their rentals in order to try and secure cash flow for vacancies that have been extending. Tenants are becoming increasingly sophisticated, and unless they are negotiating gross rentals, are looking very closely at operating costs. Land tax and insurance are the big ones, with land values having increased substantially leading up to recent years. This has had a major impact on land tax increases, but insurances have also increased substantially as well. Electricity is another one to look out for. We expect outgoings to regulate over the coming years, with land values flattening now and the rolling 3-year average for land tax having washed through now. Investors have been sitting on the sidelines in this high cost of funding environment unless there's been a compelling reason for them to participate. Owner-occupiers, on the other hand, have remained active, although they are cautious not to overpay and are also looking very carefully at the right opportunities. When there is an asset coming to market, whether it be publicly marketed or off-market, and investors and owner-occupiers are pitching for it, owner-occupiers are particularly more aggressive on pricing than it comes to investors. Now the federal election has been and gone, there are early signs of an uptick in business confidence, although we do caution you and say that they are early signs. When it comes to investors and developers, they need to see value. It needs to make mathematical sense. For example, if it makes sense from a mathematics point of view, they are active. If it doesn't make sense from a maths point of view and there's no emotion attached, they will not overpay and become engaged in a process to buy a property. My advice for investors and developers for the months ahead is, when entering negotiations, be decisive and minimise DD and settlement periods as much as possible so as to give vendors certainty going into negotiations. My further advice would be to reprice assets as the cost of funding decreases with predicted cash rate and therefore interest rate reductions.